market outlook for the end of June 2025. Today, I'm going to give you some evidence to suggest that July may actually be a very positive month for the North American stock markets, but I'm also going to look at why markets may still have some excess to work out with possible volatility after this positive July. It's all technical because I'm a technical analyst. My name is Keith Richards. I'm president and chief portfolio manager at ValueTrend Wealth Management. And this is the Smart Money, Dumb Money. And remember, you're smart money because you're watching this video. Let's take a look at the S&P 500 and the TSX 300 charts. I'm just going to cover the basics here, but we'll dive a little bit deeper as this show goes on. So old highs on the S&P 500 were 61.47 or very close to that. And we're just coming in to test that level. We're very, very close to the old highs. What the charts need to do is show a move above the old highs, because the definition of an uptrend is higher highs, higher lows. We've got that in some form, but we still need to take out the old highs to resume the bigger picture long-term uptrend on the S&P 500. On the positive is this gap up. In fact, you can see by looking a little closer that the market definitely did a nice gap when the positive news on the end of hostilities out of Iran came to a front in the third week of June. Well, we're holding above the 200-day, we're holding above the 50-day. Everything looks pretty good as far as the overall picture. It may continue to tread sideways for a little bit, but the likelihood is that we eventually get a move to the upside. Now, what may curtail that in the near term is we can look at, again, this is all daily chart stuff, so this is very short term, but you can see there's a little bit of negative divergence on the MACD, a little bit of negative divergence on RSI, and a little bit of negative divergence on stochastics. This is all short-term stuff, so we may not see that pop to new highs in a super short period of time, but as I'm going to show you shortly, there is some potential for some point in July seeing that pop. Let's now look at the TSX. You guys know that early January, I began touting the merits of overweighting the TSX in your portfolio. I was right. The TSX has outperformed the S&P 500 by a fairly wide margin. Now, what's really important to notice here on this chart, and I have mentioned this a couple times in videos before, is that the TSX broke its old highs. Remember, we were just looking at the S&P 500, and it has yet to break the old highs. I think it will, but we have a little bit of waiting to do before that happens. Meanwhile, the TSX broke out, and all looks pretty good. It's above the 200, it's above the 50, and it's making new highs. That's the definition of an uptrend. Now, we do have some short-term warning signs with diverging MACD, diverging RSI, and diverging stochastics, just like we saw on the S&P chart. So keep that in mind. We may see treading water, I guess you could say, for a short period of time, but I'm going to present you with some evidence now that suggests that maybe in July, we get that next move on the markets. Okay, so why do I think July might be a positive month for North American markets? Let's take a look at seasonality, and this is courtesy of Equity Clock. You can see that typically right into July, markets are typically flat, and they have been, haven't they? I mean, TSX has outperformed, but certainly this is a S&P 500 seasonal chart, and you can see that markets have followed their seasonal pattern of being pretty flat over this spring. But as you can see on this red line here, July is more often than not a positive month. So seasonals will be in our favor, and it does seem that the S&P is following its seasonal pattern that it tends to go sideways in the spring. So we may get a pop in July, but keep in mind thereafter, it often moves back into a more or less sideways type of market. So I think the seasonals are giving some clues to suggest that markets may move up in July. Another factor that I think is important to keep in mind is the Federal Reserve. The U.S. Federal Reserve tends to lead the market through monetary policy at times. It certainly has over the last 20 years. So what are the odds of a Fed cut? Well, the odds of a Fed cut in July were extremely low just a few weeks ago. In fact, the Fed cut, and this is last week, that's basically the week coming into when I'm recording this, which is June 25th. Well, the Fed cut chances were 10%. Well, that's recently moved up. I'm recording this actually on the 25th of June. You're probably seeing this a couple days later. But the point is that the odds of a Fed cut in July moved up more than double. Now, it's still very low. It's only 23% of a potential for the Fed cutting, but still, that's a sizable movement. And the market will react to that. The market wants to see a cut. When the odds increase, even though it's not the 70% odds or anything like that, when the odds increase, the market starts to get more positive. So that's another reason why I think July could be positive, more on the perception of the potential of a Fed cut. Next thing to talk about, and I've talked about this a couple of times in the past, but insiders. Now, we can look at the S&P 500 components, and we can look at all 500, it's actually a little over 500 stocks. We can look at all 500 stocks and see what the insiders are doing. Insiders are key executives, key shareholders of the company's stock, and we can look at their buy to sell ratio. If they're buying, that usually means they're confident of the pricing of their stocks. If they're selling, it usually means the opposite. It means that they think their own stocks are overpriced, and that's why they start to sell, just to get some profits because they think that things have gotten out of hand. Now, you can take a look at history, and you can see I've circled in red that when insiders are underconfident about their stocks, in other words, they think they're overpriced. It doesn't mean they dislike their companies. It just means they feel that they're overpriced. They'll start net selling. Doesn't mean they're selling everything, but they start to net sell. And you can see that often lines up with near market tops. And in fact, it did recently in late 24, early 25. But you can also see that when insiders become interested in their stocks, the buying versus selling ratio increases. And you can see whenever that happens, it tends to signal a bullish market for the S&P 500. So this is all of the S&P stocks. It's not just one or two of them, and it's telling us net on aggregate, insiders are either net buying, selling. All right. So again, they buy near the bottoms. They like buying near the bottom here in 22. They bought near the bottom mid 23, and they saw a pop. Well, recently, as you can see here, they've moved up from a underconfident position, in other words, where they didn't necessarily want to buy their own stocks, to they are starting to buy their own stocks. That's a positive because that should lead into higher stock prices in aggregate on the S&P 500 and the stocks. Now let's take a look at what smart money is doing versus dumb money. Now you guys know I've named my show after this, and I've even written a book on smart money, dumb money. We can look at large institutional traders, professional investors, commercial hedgers, that kind of thing. These people are generally considered smart money. Now, dumb money is retail investors, and that's no insult to anyone that's watching the show because you guys are smart money for watching the show, but just understand that retail investors tend, on aggregate, to buy at market peaks and sell aggressively at market bottoms. It's just a pattern that's been around for as long as the market's been around. And what we look for is extremes. So in other words, when the ratio of smart money versus dumb money, confidence, in other words, their buying or selling activity, increases in favor of smart money buying, we want to get in on the market, and vice versa. So what we can look at here is when this line is when the indicator is at the lower end of its range, that indicates that the ratio of smart money versus dumb money is in favor of dumb money buying, dumb money confidence. And that's the worst time to be in the market. So we can take a look. Typically, when dumb money is confident, sometimes it only gives us short-term signals. So I'm not drawing that line very short. You can see it gave us a little blip there. You can see here it definitely signaled quite nicely this top, and here it signaled near this top, and here it signaled near a much larger top leading into the 2022 drawdown. Now the opposite is true. When smart money begins to buy, we can see that it often signals good buying opportunities. Here was a pretty good buying opportunity when they liked the market there, and most certainly smart money was net buying and dumb money was net selling at the bottom of the 2022 market sell-off. Well, what do we got here is dumb money was recently buying, which is not a great thing, and the market pulled back a bit. But what we're seeing now is the smart money is beginning to buy. It's not in that zone where smart money is overwhelmingly buying at this point. In fact, it looks like they're just starting to. So we have to keep our eye on this because dumb money may still be in control. In other words, retail investors may be driving this market. We want the institutions, the pension managers, the big commercial hedgers to be buying. Right now, they're not buying aggressively. So that is a caution sign, but it's still some sign that they're over pessimism, which happened fairly recently, is reversing. So let's keep an eye on that. One of the charts that I have shown you guys before is the relationship between the US long bonds and the US markets, meaning the S&P 500 as the index we're talking about today. Generally speaking, you want to see bond prices moving up alongside of stock prices. It's not a perfect relationship. It's a general relationship. Let's call it that. What I look for is extremes. One example I want to talk about is how the bond market began selling off leading into the 2022 stock market sell-off. But at that time, you had divergence. You had the bond market selling off and the stock market going up. That doesn't last for long. You usually get some sort of correction. So my fears are that right now we have a very strong stock market, even taking into account the recent sell-off when Trump announced his tariffs earlier this year. But generally speaking, the S&P has been very, very strong. And at the same time, the Treasury bond market has been quite weak. That relationship does not last forever historically. Eventually, as I like to tell people, the jaws will close. The differential between the two will come together. And that can be either bonds going up, stocks going down, or both. I'm seeing a little bit of action on the bonds lately, and that means that perhaps it will be that the bonds just start to play catch up. So this is not all bad news, but you want to see this relationship return to a more normalized relationship where the two are roughly moving together. Final word of caution as to why there may be more volatility after some sort of a potential spike in July is the valuations on the market. Now, everybody knows what a PE ratio is, price to earnings. This is trailing earnings, which are the only kind of earnings I ever follow. Forward earnings are estimations by analysts. Trailing is reality. So what we want to do is take a look at long history on PE ratios. Now, I understand that growth in the late 1800s and early 1900s was nowhere near what the growth has been due to consumerism and technology and all that sort of stuff on the markets these days. So the ratios are allowed to expand as growth on markets like earnings growth, potential profit growth increases on a percentage basis. So you're going to see expanding multiples over time. However, you can look at recent history. So even if we forget what happened between, say, 1870 and 2000, where multiples generally hung around 20 at the highest, now we see multiples getting into sort of the 30 range. And odd spikes such as the tech bubble, COVID, that kind of thing, where they reach that level. But right now, if I sort of erase a couple of my lines here, you'll see that the S&P 500's trailing PE ratio is around 29. It's kind of approaching that upper end of its range at 30. So we don't want to see that PE ratio expand too much past 30, because in modern times, when it's expanded too much past 30, we often see a market correction. No predictions here. I'm just pointing this out, that this is another one of the risks that we face on the market in the mid to longer term. So in conclusion, my thoughts are that we will probably see the market break its old highs of at around 6150 or so on the S&P 500, and I think the TSX will continue to moving up, particularly because the TSX is weighted in commodities, and you guys know how I like commodities. But I do think that we need to be cautious after any such move, because markets may still have some excess to work out because of the bond to stock ratio, because of PE ratios, and we're really not seeing a lot of smart money buying in just yet, and they're usually a little bit ahead of the curve. So keep these things in mind. There's no doom and gloom message here, but I am telling you that we want to be cautious after any near-term moves, because things are still not set up for a raging bull at this point. All good for the summer though, so I'm looking out for a possible move in July, and perhaps if we see any weakness coming into July, we may want to consider moving into some stocks that we favor, because it might be opportunistic. Thanks for watching, and don't forget, like and subscribe. Remember, we're trying to get to 20,000 viewers, and Rebecca needs those subscriptions to get her bonus. So get on it, guys, and subscribe and tell your friends about this channel. Thanks for watching. We'll see you next week. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at ValueTrend. And by the way, I don't just talk the talk. I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.